Before we begin, a quick and important disclaimer. The following video is for educational and entertainment purposes only and does not constitute professional, legal, tax, or financial advice. We are discussing complex topics involving the United States tax code, ERISA regulations, and domestic relations laws. Every individual's financial situation and legal jurisdiction is unique. You should always consult with a qualified attorney, certified public accountant, or licensed financial advisor before making any decisions regarding your retirement assets or legal settlements. Conduct your own due diligence and do not rely solely on the information presented here. There is a silent, multi-trillion-dollar erosion happening in the American middle class right now, and it isn't just because of inflation or the rising cost of housing. It is happening in the one place most Americans feel safest: their 401k. For decades, the 401k has been marketed as the ultimate vehicle for American prosperity, the cornerstone of the three-legged stool of retirement. But there is a mathematical trapdoor that most people don't see until it is too late. When a marriage dissolves in the United States, that 401k, which might represent 20 or 30 years of disciplined labor, is often the single largest asset on the table. It is frequently larger than the home equity itself. Yet, because of the way wealth is distributed in this country and the specific federal laws governing these accounts, a divorce doesn't just split the money in half. In many cases, the combination of legal fees, early withdrawal penalties, tax implications, and the loss of compound interest effectively destroys 40 to 60% of the account's future purchasing power in a matter of months. We are entering an era where the average American worker is more likely to experience a significant retirement account haircut through legal proceedings than through a market crash. While we watch the headlines about the top 1% holding more wealth than the entire middle class, we ignore the granular mechanics of how wealth is actually stripped away from the remaining 60%. This is the story of how the most common financial instrument in America becomes a weapon of mass financial destruction during a legal separation, and how that reality is fundamentally reshaping the wealth gap in the United States. By the end of this deep dive, you will understand the exact mechanics of the Qualified Domestic Relations Order, or QDRO, and why it is the most powerful legal document you have never heard of. We are going to break down why the U.S. wealth distribution is increasingly top-heavy, and how the vulnerability of retirement accounts plays a pivotal role in keeping the middle class in a state of perpetual catch-up. This isn't just about the end of a marriage, it's about the anatomy of American wealth, the systemic risks of the 401k system, and the specific strategies used to navigate the intersection of family law and federal retirement statutes. To understand why a 401k is so vulnerable, we have to look at the macro-level distribution of wealth in the United States. As of the mid-2020s, the top 10% of households hold approximately 70% of the total wealth in the country. The bottom 50% hold just about 3%. For the vast majority of people in the middle, their wealth is not liquid. It isn't sitting in high-yield savings accounts or diversified brokerage accounts. It is tied up in two specific places: their primary residence and their employer-sponsored 401k. This creates a high-stakes bottleneck. In the 1970s, before the 401k became the dominant retirement vehicle, many workers had defined benefit pensions. These were promises of future income. When a couple divorced, the pension was a future stream of payments, which was difficult to value and even more difficult to split. But the 401k is a defined contribution plan. It is a bucket of cash with a clear, daily updated dollar amount attached to it. This makes it an incredibly shiny object during a divorce settlement. It is easy for a lawyer to point at a screen and say, "There is $500,000 in that account, and my client is entitled to half." However, that $500,000 is a gross number, not a net number. This is where the first layer of the wealth erosion begins. Because 401ks are typically funded with pre-tax dollars, every cent in that account carries a future tax liability. If a court orders a 50-50 split, and one spouse takes their half as a cash out to buy a new home or pay legal fees, they aren't getting $250,000. They are getting $250,000 minus a 10% early withdrawal penalty if they are under age 59 and a half, minus federal income tax, and minus state income tax. In a high-tax state like California or New York, a spouse could walk away with less than $150,000 from what looked like a $250,000 settlement. This is a massive, immediate transfer of wealth from the individual to the government, triggered solely by the legal event of divorce. Now let's look at the systemic side of this. When we talk about wealth distribution, we often talk about the great transfer of wealth from boomers to millennials. But divorce acts as a massive interruption of that transfer. When a 401k is liquidated or split inefficiently, the power of compound interest is permanently broken. If you have $300,000 compounding at 7%, you have a specific trajectory for your golden years. If that account is split into two pools of $150,000, and those pools are further diminished by taxes and fees, the mathematical reality is that neither individual will ever reach the original projected level of wealth. They have lost the critical mass required for exponential growth. This is a major contributor to the downward mobility, often seen in the American middle class. It explains why two people who were firmly in the middle class during their marriage often find themselves sliding into the lower middle or working class individually after a 401k split. They no longer have the capital to participate in the wealth-building mechanics that the top 10% used to stay ahead. The legal mechanism that governs this entire process is the QDRO. Under the Employee Retirement Income Security Act of 1974, or ERISA, retirement plans are generally protected from creditors and legal judgments. You can't just tell a bank to hand over half of a 401k because of a divorce decree. The plan administrator is legally forbidden from doing that. The only way to pierce that veil is through a QDR. This is a highly specific legal order that must be drafted by an attorney, approved by a judge, and then this is the part many people miss, accepted by the 401k plan administrator. If the QDRO is drafted incorrectly, even by one comma or one vague date, the plan administrator will reject it. While the lawyers argue and the paperwork sits in limbo, the market continues to fluctuate. We have seen case studies where a spouse was awarded a specific dollar amount, but by the time the QDRO was actually processed months later, the market had dipped, and the account didn't even have enough funds to cover the original award. Or conversely, the account grew significantly, but the non-employee spouse missed out on all the gains because the order specified a fixed dollar amount rather than a percentage. This technical complexity is a barrier to entry. High-net-worth individuals have the capital to hire specialized QDRO attorneys who ensure the transfer is seamless and tax-efficient. They use techniques like offsetting, where one spouse keeps the 401k and the other spouse takes an equivalent value in another asset, like the house, to keep the retirement funds intact and compounding. But for the average American, whose only real asset is that 401k, there is nothing to offset with. They are forced to split the account, incur the fees, and bear the systemic brunt of the wealth gap. In the next sections of this masterclass, we are going to dive into the specific math of these splits, the different ways states handle separate versus marital property, and how the timing of your contributions can be the difference between losing everything and protecting your future. We are moving from the macro view of U.S. wealth into the micro view of your personal balance sheet. This is the reality of the 401k era. Your retirement isn't just subject to the whims of the S&P 500. It is subject to the fine print of federal law and the stability of your domestic life. Understanding this intersection is the only way to navigate the modern American economy. To understand the gravity of this situation in 2026, we have to look at the math through the eyes of a typical American worker. Imagine a professional named Alex. Alex is 45 years old and has spent the last 20 years working as a project manager in Columbus, Ohio. Over 2 decades of disciplined 401k contributions, including company matches and a steady 7% average annual return, Alex has built a nest egg of $450,000. In the eyes of the U.S. wealth distribution metrics, Alex is a success story. Alex is in the 60th percentile of American earners, part of the bedrock of the middle class. But Alex is currently entering a legal separation, and this is where the theoretical value of that 401k meets the cold reality of the U.S. legal system and the Internal Revenue Service. In many states, particularly community property states like California or Texas, the law generally views any assets acquired during the marriage as owned equally by both parties. Even in equitable distribution states, the court looks at the length of the marriage and the contributions of both spouses to decide what is fair. In Alex's case, $400,000 of that 401k was earned while married. The court determines that Alex's spouse, Jordan, is entitled to 50% of that marital portion. On paper, it looks simple. Jordan gets $200,000, and Alex keeps $250,000. But as we transition into the implementation phase, the true erosion of wealth begins. This leads us to the first critical step in the deep dive: the valuation date. This is a detail that can shift the outcome of a settlement by tens of thousands of dollars. Historically, courts might use the date of filing, the date of the final decree, or the date of actual asset transfer. If the market is volatile, as we have seen in early 2026, a delay of just 3 months in processing paperwork can mean that the 401k has dropped or risen by 10%. If the court order specifies a fixed dollar amount of $200,000 for Jordan, and the market drops, Alex is left holding a significantly smaller remainder. Conversely, if the market gains, Jordan misses out on those gains because the order was not drafted as a percentage of the account. This is the first point where middle-class wealth is vaporized through administrative friction. Now, consider the mechanics of the transfer itself. Most people assume Alex just writes a check. That is impossible with a 401k without triggering massive tax consequences. Instead, they must use the Qualified Domestic Relations Order, or QDRO. The step-by-step process for a QDRO is a bureaucratic gauntlet. First, an attorney must draft the order to comply specifically with the rules of Alex's employer's 401k plan. Every plan is different. Some plans allow for an immediate lump sum transfer to an IRA for Jordan. Others require the money to stay in the original plan until Alex reaches retirement age. If Jordan needs cash now to secure a new apartment or pay legal retainers, they might be tempted to take the $200,000 as a cash distribution. Here is the historical trend of what happens next. The 10% early withdrawal penalty usually applies to 401k withdrawals before age 59 and a half. However, there is a specific exception under Internal Revenue Code Section 72(t)(2)(c). If the distribution is made pursuant to a QDRO, the 10% penalty is waived for the alternate payee, in this case Jordan. But, and this is a massive but, the distribution is still treated as taxable income. If Jordan takes that $200,000 as cash in 2026, that amount is added to their other income for the year. This likely pushes Jordan into the highest possible tax brackets. Between federal income tax, state tax, and local taxes, Jordan might see 30 to 40% of that $200,000 go directly to the government. Instead of a $200,000 fresh start, Jordan has $120,000. Meanwhile, Alex's account has been depleted by the full $200,000. In total, the household wealth, the money available to support Alex, Jordan, and their children, has shrunk by $80,000 in a single tax year. This is wealth that will never be reinvested. It will never benefit from the eighth wonder of the world, compound interest. To put this in perspective regarding U.S. wealth distribution, let's look at the opportunity cost. If that $80,000 had remained invested at a 7% return for another 20 years, it would have grown to over $300,000. By settling for cash now, the family has not just lost $80,000 today. They have effectively deleted $300,000 from their future legacy. This is why divorce is often cited by sociologists as a primary driver of wealth inequality. High net worth individuals, the top 1%, rarely take these cash outs. They have enough liquidity in other accounts to leave the 401k untouched, or to offset the value with other assets like real estate or brokerage accounts. The middle class, lacking that liquidity, is forced into the tax trap. We also have to discuss the hidden costs of the QDRO process itself. In 2026, a specialized QDRO attorney can charge anywhere from $1,500 to $5,000 just to draft the document. Then, the plan administrator often charges an administrative fee to review and process the order, which can be several $100s deducted directly from the account. If the order is rejected for a technicality, perhaps it didn't specify how to handle outstanding 401k loans, the clock resets, and the legal fees climb. Speaking of 401k loans, this is a massive complication in the current economic climate. Many Americans like Alex have taken loans against their 401k to pay for a roof repair or a child's tuition. In a divorce, if there is an outstanding loan of $30,000, the court must decide who is responsible for the debt. If Alex is ordered to pay it back, but can no longer afford the payments due to new alimony or child support obligations, the loan is treated as a deemed distribution. This means the IRS considers the $30,000 as income, Alex owes taxes on it, and if Alex is under 59 and a half, a 10% penalty applies. This adds another layer of financial burden at the worst possible moment. Case studies from the last few years show that the psychological impact of seeing a 401k balance drop by half often leads to investment paralysis. Alex might become so risk-averse after losing $200,000 that he moves his remaining $250,000 into a stable value fund or cash equivalents, fearing another loss through market volatility. By doing this, Alex stops participating in the growth of the U.S. economy. While the top 10% of households continue to ride the wave of equity growth, Alex's wealth stagnates. This is the invisible mechanism of the wealth gap. It isn't just about what you have, it's about your ability to stay in the game. The systemic issue here is that the 401k system was never designed to be the primary source of wealth for the American public. It was intended as a supplement to pensions. Now that it is the primary source, its fragility during life transitions like divorce is creating a permanent underclass of formerly middle-class retirees. We are seeing a trend where individuals are reaching age 65 with less than $100,000 in total assets because their compounding cycle was broken 15 or 20 years prior. But what if there was a way to divide these assets that didn't involve the QDRO trap? What if there were specific clauses you could include in a prenuptial or postnuptial agreement that act as a firewall for your compound interest? And more importantly, how do the current 2026 tax laws regarding separate property contributions actually work when you've been mixing funds for a decade? In the next part, we are going to look at the trace and separate strategy. We will explore how to prove exactly which dollars in your 401k were yours before the marriage began, potentially saving you hundreds of thousands of dollars from the 50% split. We will also break down the life insurance swap, a little-known tactic used by high-end financial planners to keep 401k accounts intact while still providing a fair settlement to a departing spouse. The difference between a standard divorce and a wealth-aware divorce is all in the documentation you prepare before the first legal filing. We are going to show you exactly what that documentation looks like and why your current 401k statement might be lying to you about what you actually own. The reason your 401k statement might be misleading you is rooted in a concept known as commingling. Most American workers look at their quarterly statement and see one total balance, let's say $600,000, and assume that is the number the court will split. However, in the eyes of the law in 2026, that $600,000 is often composed of two distinct legal categories: separate property and marital property. This is where the trace and separate strategy becomes the most vital tool in your financial arsenal. To understand how this works, let's look at a case study involving a character named Sarah, a software engineer in Austin, Texas. Sarah started her career at age 22 and was incredibly diligent. By the time she married her spouse, Mark, at age 30, she already had $150,000 in her 401k. For the next 10 years of their marriage, she continued to contribute, and her employer continued to match. By 2026, the couple is filing for divorce, and the account has grown to $650,000. Under a standard, lazy interpretation of the law, a mediator might suggest they simply split the $650,000 down the middle. If Sarah agrees to this, she is effectively gifting Mark a significant portion of the wealth she built before they even met. The trace and separate strategy requires Sarah to go back and find the exact statement from the month she was married. This sounds simple, but many 401k providers only keep records online for 7 to 10 years. If Sarah didn't download those PDFs a decade ago, she is now in a race against time to subpoena archived records from a previous employer's plan administrator. Let's assume Sarah has the records. She proves that $150,000 was her separate property. But the calculation doesn't stop there. We have to account for the passive appreciation of that $150,000. Historically, courts have grappled with whether the growth on separate property remains separate. In many jurisdictions, if that $150,000 grew to $350,000 purely due to market performance, without any new marital funds being added to that specific slice of the pie, Sarah might be able to claim the full $350,000 as her separate property. The remaining $300,000, which came from contributions made during the marriage and their subsequent growth, would then be the only portion subject to the 50-50 split. In this scenario, Sarah walks away with $500,000, and Mark receives $150,000. The difference between Sarah using a tracing expert and Sarah accepting a default split is a staggering $175,000. This isn't just math. It is the preservation of a decade of labor. This leads us to the step-by-step details of the tracing audit. Step 1 is the identification of all plan participants and sponsors from the date of marriage to the present. Step 2 is the categorization of every single contribution. You must distinguish between employee deferrals, employer matching, and any profit-sharing contributions. Step 3 is the application of the Moore-Marsden formula or similar state-specific legal precedents, which determine the community versus separate interests in an asset that has increased in value. In 2026, forensic accountants use specialized software to run these simulations, but the quality of the output depends entirely on the paper trail you provide. If you cannot prove the starting balance, the court typically defaults to the assumption that the entire account is marital property. This is a massive systemic disadvantage for people who switch jobs frequently and roll their 401ks into new plans, losing the granular history of their earlier contributions. Beyond tracing, we must discuss the life insurance swap, a strategy often utilized by high-net-worth individuals to bypass the QDRO tax trap. Imagine a scenario where the 401k is the largest asset, but there is also a significant life insurance policy or other liquid assets available. Instead of carving up the 401k and stopping the compounding process, the participant spouse might buy out the other spouse's interest using other funds. In 2026, we are seeing more cases where a spouse agrees to take a larger share of the home equity, or a specific cash settlement in exchange for leaving the 401k untouched. However, there is a dangerous pitfall here: the valuation error. If the 401k is worth $500,000, it is not actually worth $500,000 in spendable cash because of the embedded tax liability we discussed earlier. If Sarah gives Mark $250,000 in cash from a savings account to keep her $500,000 401k, she has actually overpaid him. She gave him clean dollars for dirty tax-impacted dollars. A professional script for a wealth-aware divorce in 2026 must include a tax adjustment calculation. You must discount the value of the 401k by the projected future tax rate, often 20 to 30%, to arrive at a true value for the swap. This ensures that the wealth distribution remains equitable in terms of actual purchasing power, not just nominal figures on a page. Now, let's connect this back to the broader U.S. wealth distribution. Why does this matter for the country? Because when middle-class participants fail to use these strategies, their wealth is siphoned off into the tax system and legal fees, rather than being passed down to the next generation. This is a form of wealth leakage. When we analyze why the top 10% of Americans are pulling away from the rest of the country, it is because they have the educational infrastructure to navigate these legal traps. They don't just have more money, they have better systems for keeping the money they have. The 401k was sold to the American public as a tool for democratization of finance. It allowed the average worker to invest in the same companies as the billionaires. But the 401k has a glass floor. During moments of extreme stress like a divorce or a medical emergency, that floor shatters, and the worker falls through into a basement of penalties and taxes that the wealthy simply do not inhabit, because their wealth is structured in trusts, LLCs, and diversified holdings that aren't tied to a single employer-sponsored plan. Consider the role of the employer in this 2026 landscape. Most HR departments are not equipped to help employees navigate the QDRO process. They provide the summary plan description and then step back, leaving the employee to fight with the plan administrator's legal department. This lack of support contributes to the high rate of errors and rejections. Every time a QDRO is rejected, it costs the American worker more in legal fees, further tilting the wealth distribution away from the individual and toward the professional services sector. We also need to address the pre-tax versus Roth complication. In 2026, many workers have hybrid accounts containing both traditional pre-tax 401k funds and Roth 401k funds. Splitting these is a mathematical nightmare. A Roth 401k is incredibly valuable because the taxes have already been paid. If a court order simply says, split the account 50-50, and the plan administrator takes all of Mark's 50% from the pre-tax bucket while Sarah keeps the Roth bucket, Sarah has won a massive financial victory without Mark even realizing he lost. The tax-free growth of a Roth account is one of the most powerful wealth-building tools in the U.S. Code, and losing it in a divorce settlement can alter a person's standard of living for decades. This brings us to a critical realization. The 401k is not just a savings account. It is a complex legal contract with the federal government and your employer. When that contract is interrupted by a divorce, you aren't just splitting money. You are renegotiating your entire financial future with the IRS as an uninvited third party at the table. But what happens when the 401k isn't the only thing being split? What happens when there is a 401k loan that was used to pay for a joint asset, but now only one person owns that asset? And what about the Social Security offset? A little-known federal rule that can actually change how much of your 401k your spouse is entitled to based on their own future government benefits. In the next part, we are going to expose the Social Security windfall elimination and how it interacts with 401k splits. we are going to look at the loan default trap and how to prevent a divorce from turning into an accidental tax audit. Most importantly, we will reveal the specific language you need in your divorce decree to ensure that you, and not the government, keep the maximum possible share of your hard-earned compounding interest. We are going deeper into the tactics that the wealth managers of the top 1% use, and how you can apply them to your own middle-class retirement. One of the most overlooked variables in the 401k divorce equation is the intersection with Social Security. To understand the gravity of this, we need to introduce a concept that high-end divorce attorneys in 2026 call the Social Security offset. Imagine a character named Robert. Robert has worked in the private sector for 30 years, diligently building a 401k that now sits at $800,000. His spouse, Elena, has spent her career as a public school teacher in a state where she does not contribute to Social Security, but instead pays into a generous state pension fund. In many jurisdictions, Robert's 401k is viewed as a divisible marital asset, but Elena's future Social Security benefits, which Robert has also contributed to through his taxes, are federally protected and cannot be divided by a state court. This creates a massive structural imbalance in wealth distribution. If the court simply splits Robert's $800,000 401k in half, Elena leaves the marriage with $400,000 plus 100% of her future Social Security equivalent pension. Robert, on the other hand, leaves with $400,000 and a significantly lower projected Social Security check because his household's total retirement security has been halved, while Elena's has been augmented. In 2026, savvy litigants are using historical trends in case law to argue for a Social Security offset. This involves hiring an actuary to calculate the present value of the Social Security benefits each spouse has earned during the marriage. If Robert's earned benefit is valued at $300,000 and Elena's is zero, the court may allow Robert to keep an extra $150,000 of his 401k to balance the scales. Failing to account for this is one of the most common ways middle-class men and women accidentally forfeit six figures of future purchasing power. Now, let us look at the technical nightmare of 401k loans during a legal separation. In the current economic climate of 2026, approximately 20% of participants have an active loan against their retirement account. Let us imagine a couple, Michael and Jennifer. 2 years ago, they took a $40,000 loan from Michael's 401k to consolidate high-interest credit card debt incurred during a home renovation. Now they are divorcing. The 401k balance is $200,000. But the $40,000 loan is still outstanding. The plan administrator sees the account value as $200,000, but the actual liquid cash is only $160,000. If a judge orders a 50% split of the $200,000, the plan will attempt to move $100,000 to Jennifer. However, Michael is still the one legally responsible for the loan repayments through his payroll deductions. If Michael leaves his job or simply cannot keep up with the payments because his income is now squeezed by separate housing costs, the loan will default. This is what the IRS calls a deemed distribution. Because the loan was used for marital expenses but is tied to Michael's individual account, Michael is hit with the income tax bill for the full $40,000, plus a 10% early withdrawal penalty if he is under 59 and a half. Jennifer walks away with her $100,000. While Michael is left with $60,000 and a massive unexpected tax debt. To prevent this, a wealth-aware divorce decree must specifically address the 401k loan. Potential outcomes include requiring the loan to be paid off from the sale of other marital assets before the 401k is split, or adjusting the percentage of the QDRO to account for the debt. For example, Jennifer might receive $80,000 instead of $100,000. Acknowledging that the $40,000 loan was a joint benefit that Michael is now solely responsible for repaying. This level of detail is what separates a standard settlement from one that actually preserves wealth. This brings us to the broader issue of the U.S. wealth distribution and the concept of the compounding floor. When a 401k is split, the primary damage isn't just the loss of the principal, it is the loss of the compounding velocity. There is a mathematical threshold where an account begins to grow faster from interest than from contributions. For most middle-class Americans, reaching that $250,000 to $500,000 range is the goal of a lifetime. It is the point where the money finally starts doing the heavy lifting. By splitting an account just as it hits this escape velocity, the legal system effectively resets both individuals to a stage where they must rely on their labor again, rather than their capital. In the top 1% of U.S. households, wealth is often held in vehicles that are specifically designed to survive a divorce. This includes domestic asset protection trusts and family limited partnerships. These structures allow the wealth to stay in a single, compounding pot while only the distributions are divided. The 401k, by contrast, is a fragile individualistic tool. It was designed for a single worker at a single company. It was never built to withstand the complexities of modern American family life. This is why we see a trend in 2026 where the retirement gap is widening even faster than the income gap. Two people can earn the same salary for 30 years, but the one who stays married or manages their 401k split with surgical precision will end up with 3 to 4 times the wealth of the one who falls into the QDRO traps. Step by step, if you are facing this situation in 2026, you must demand a plan summary description from the employer. You must look for the section on QDROs. Some plans are segregated, meaning they create a separate account for the ex-spouse immediately. Others are non-segregated, meaning the ex-spouse just gets a lien on the account until a triggering event occurs, like the employee's retirement or death. If you are the spouse receiving the money, a non-segregated plan is a major risk. If the employee spouse makes bad investment choices or takes a massive hardship withdrawal, your share could evaporate before you ever touch it. Furthermore, we have to talk about the investment direction during the shadow period. This is the time between the divorce filing and the final processing of the QDRO, which can take 6 to 18 months. During this time, who controls the investments? If Michael has the 401k and he is angry about the divorce, he might move the entire account into a low-yield cash fund to spite Jennifer, or worse, into a highly speculative asset that crashes. In 2026, we are seeing more interim financial injunctions that freeze the investment allocation of a 401k at the time of filing to prevent this kind of financial sabotage. This leads us to a startling realization about the current state of American wealth. The 401k system has turned every middle-class worker into a de facto hedge fund manager of their own life, but without any of the legal protections or professional redundancies that real hedge funds enjoy. One bad legal turn, one missing paragraph in a court order, and 20 years of discipline can be wiped out. This is a systemic vulnerability that the wealthiest Americans simply do not share. But there is an even deeper layer to this. What happens when the 401k contains company stock? What if the company you work for is private, and the valuation of that stock is subjective? And how does the 2026 Secure Act 3.0 update change the way the IRS looks at these transfers? Most importantly, there is a strategy involving the net unrealized appreciation, or NUA rule, that could allow you to pull money out of a 401k during a divorce while paying capital gains rates instead of high income tax rates. In the next part, we are going to break down the NUA strategy, the single most effective way to save 40% on taxes during a 401k split if your account contains employer stock. We will also explore the valuation date arbitrage, and how the specific day the judge signs your paper could cost you or save you a year's salary. We are moving into the elite tactics of forensic accounting to show you how to find the hidden value that your spouse's attorney might be trying to overlook. The difference between a middle-class retirement and a struggle is often found in the margins of these federal codes. The difference between a middle-class retirement and a lifelong struggle is often found in the margins of federal tax codes that most people never read. As we move into 2026, the complexity of these codes has reached a fever pitch, particularly for those whose 401k contains employer stock. This brings us to a high-level forensic strategy known as net unrealized appreciation, or NUA. If you are in the middle of a divorce and your 401k includes shares of your employer's company, the NUA rule is potentially the single most effective way to prevent the IRS from taking a massive bite out of your settlement. To understand how NUA works in a divorce context, let's look at a case study involving a character named David. David has been with a major U.S. aerospace firm for 25 years. Over that time, he participated in a company stock fund within his 401k. The cost basis, the price at which the stock was originally purchased for his account, is $100,000. However, thanks to 2 decades of market growth, those shares are now worth $500,000. If David simply rolls this money over into an IRA or splits it via a standard QDRO, every dollar that eventually comes out of that account will be taxed at his ordinary income tax rate, which in 2026 could be as high as 37%. But under the NUA rules, if David takes a lump sum distribution of the company stock as part of a QDRO, the tax treatment changes fundamentally. He only pays ordinary income tax on the $100,000 cost basis. The $400,000 of growth, the net unrealized appreciation, is not taxed at the time of distribution. Instead, when those shares are eventually sold, that $400,000 is taxed at the long-term capital gains rate, which is typically much lower, often around 15 to 20%. In a divorce settlement, the difference between paying 37% and 20% on $400,000 is a staggering $68,000 in tax savings. If your attorney doesn't know to ask for an NUA-compliant distribution, you are effectively leaving a luxury SUV's worth of cash on the table for the government. Plus 2. However, NUA is a double-edged sword. To qualify, you must meet very specific IRS criteria, and the distribution must be a total lump sum of all assets in that specific plan. If David's ex-spouse, Karen, receives half of the account, she needs to decide if she wants to utilize the NUA treatment for her portion as well. This requires her to transfer the shares into a taxable brokerage account rather than a traditional IRA. Many spouses make the mistake of thinking an IRA is always better because it defers taxes. But if the goal is to use the money in the next 5 to 10 years, perhaps to buy a new home after the split, the NUA strategy allows her to access the funds at capital gains rates, rather than being hit with a massive income tax bill and a potential 10% penalty. Now let's pivot to a concept that forensic accountants call valuation date arbitrage. In a volatile 2026 market, the day the judge signs your divorce decree can be just as important as the percentage you are awarded. Imagine a scenario where a 401k is worth $1 million on January 1st, the date the couple agrees to a 50-50 split. But due to a backlog in the court system, the QDRO isn't officially signed until June 1st. If the market has dropped by 15% in that window, the account is now worth only $850,000. The wording of the decree is everything here. If the decree says Karen is awarded $500,000, David is left with only $350,000. He has absorbed 100% of the market loss. If the decree says Karen is awarded 50% of the account value as of January 1st, the plan administrator may still only be able to distribute $500,000, leaving David holding the bag. High-retention legal strategies in 2026 now insist on language that specifies a percentage of the account including gains and losses from a specific date until the date of distribution. This ensures that both parties share the market risk and the market reward during the shadow period of the legal process. This brings us to the recent updates in the Secure Act 3.0, which has introduced new layers of complexity to how we view 401k beneficiaries and distributions. One of the most significant changes involves the mandatory Roth catch-up contributions for high earners. If you are over age 50 and earn above a certain threshold, the law now requires your catch-up contributions to be made into a Roth account. In a divorce, this creates two different buckets of money within the same 401k, pre-tax and post-tax. If the divorce decree doesn't specify which bucket the 50% split comes from, the plan administrator might default to a pro rata split, or worse, the participant spouse might try to give the ex-spouse all of the pre-tax money while keeping the tax-free Roth money. In 2026, we are seeing a massive increase in litigation over these hidden tax advantages. A $100,000 Roth bucket is worth significantly more than a $100,000 traditional bucket. If you are the spouse receiving the transfer, you must ensure your QDRO explicitly demands a proportional share of every sub-account, including the Roth portions. Step by step, you need to conduct what is called a plan feature audit. Step 1. Obtain the most recent summary plan description. Step 2. Identify if the plan allows for partial QDRO distributions, or if it must be a single event. Step 3. Check for any outstanding 401k loans, as these are often treated as distributions that can trigger taxes for the person who didn't even get the money. Step 4. Analyze the vesting schedule. If you are splitting an account where some of the employer match hasn't fully vested yet, who gets the unvested portion if the employee stays at the company until it vests? If you don't account for this in the decree, the non-employee spouse might lose out on tens of thousands of dollars in future wealth that was technically earned during the marriage. These mechanics are the gears of the U.S. wealth distribution system. The reason the top 10% of Americans hold the vast majority of retirement assets is that they use these specific forensic tools to prevent wealth leaks. They treat their 401k not as a savings account, but as a corporate entity that requires a sophisticated exit strategy. For the middle class, a divorce is often the point where the compounding floor falls out, because they lack the specialized knowledge to navigate NUA, valuation arbitrage, and Secure Act 3.0 sub-accounting. We are seeing a trend where the divorce penalty, is becoming a permanent fixture of the American economic landscape. It's not just about the cost of lawyers. It's about the structural way our retirement system is built. It is an individualistic system trying to solve a communal problem, the family unit. When that unit breaks, the individualistic tools we've been given often fail to protect the very wealth they were supposed to create. But what if the 401k isn't the only thing at risk? What if you have a 401k and a pension, and your state uses the covered service rule to determine your split? And how do you handle the hidden fees that some 401k providers charge specifically for processing a divorce, which can sometimes reach into the thousands of dollars? In the next part, we are going to expose the pension appraisal trap, why your 401k statement and your pension statement are two completely different species of animal. We will also look at the clawback clauses used by plan administrators to take back money months after you thought the divorce was final. Most importantly, we will reveal the anti-spite investment strategy, how to legally prevent your ex from sabotaging the 401k's growth while the lawyers are still fighting. The game is changing in 2026, and if you don't know the new rules, you're playing with an empty hand. The transition from a 401k to a pension-integrated retirement plan is where many Americans fall into the pension appraisal trap. To understand this, let us look at the case of a character named Marcus, a civil engineer in Virginia who has both a traditional 401k and a defined benefit pension. In 2026, Marcus and his spouse, Chloe, are calculating their marital assets. The 401k is straightforward. The statement says $300,000. But the pension statement simply says that upon retirement at age 65, Marcus will receive $4,000 per month. Chloe's attorney argues that since they were married for 15 of the 20 years Marcus has been at the firm, she is entitled to half of that future monthly payment. This is where the math gets dangerous. A $4,000 monthly payment starting 10 years from now is not the same as having cash in a 401k today. To compare these two different species of assets, a forensic actuary must perform a present value calculation. They look at historical trends in interest rates, mortality tables, and inflation projections for 2026 and beyond. If the actuary determines the present value of that pension is $600,000, suddenly the total marital pot isn't $300,000, it is $900,000. If Chloe takes the entire 401k and Marcus keeps the pension, Marcus might feel like he won because he kept the bigger asset. However, if Marcus passes away before age 65, or if the pension plan is underfunded and restructured, a rising trend in some industrial sectors, he could end up with nothing, while Chloe has already walked away with liquid cash. This disparity in asset quality is a primary driver of how wealth is redistributed during life transitions in the United States. Furthermore, we must address the covered service rule. This rule determines exactly which years of work count toward the marital portion of a retirement plan. If Marcus worked for 5 years before the marriage, those years are his separate property. But pensions often use a formula based on the highest average salary earned over the final 3 years of employment. If those highest earning years occur long after the divorce, the ex-spouse might still try to claim a piece of that higher payout, arguing that the early years of the marriage provided the foundation for that later success. This is often settled using the Majoska's formula, which creates a fraction where the numerator is the months of marriage during covered service and the denominator is the total months of service. In 2026, missing this calculation by even a few months can result in a lifetime of overpayments or underpayments totaling tens of thousands of dollars. Now, let us expose the hidden fees and the clawback clauses that are becoming more prevalent in 401k administration. In the 401k world of 2026, plan administrators have offloaded the cost of legal compliance onto the participants. When a QDRO is submitted, many major providers now charge a QDRO review fee. This is not a small administrative fee. We are seeing case studies where providers charge between $500 and $2,500 just to have their legal team look at the document. This fee is often deducted directly from the 401k balance before the split happens. If you are already splitting a smaller account, this fee represents a significant percentage of your remaining wealth. Even more concerning is the clawback clause. Imagine Chloe receives her $150,000 share of the 401k, moves it to her own IRA, and starts reinvesting it. 6 months later, the plan administrator realizes they made a clerical error and overpaid her by $10,000 because they failed to account for an outstanding loan Marcus had taken. In 2026, ERISA laws give plan administrators broad powers to demand that money back. If Chloe has already spent that money or if the market has dropped, she is still legally obligated to return the full nominal amount. This creates a state of financial insecurity that can last for years after the divorce is finalized. To mitigate these risks, you must implement the anti-sabotage investment strategy. During the shadow period, the time between filing for divorce and the actual transfer of funds, the participant spouse usually retains full control over the investment allocations. In a high-conflict divorce, there is a risk of financial vindictiveness. We have seen historical trends where a spouse, knowing they are about to lose half of their account, moves the entire balance into high-risk, speculative options, or conversely, moves everything to a zero-interest cash holding during a massive market rally. To prevent this in 2026, your legal team should file a standing order or a financial injunction the moment the divorce is initiated. This legal document mandates that the investment allocation must remain in a diversified, neutral posture, or must mirror the allocation that existed during the marriage. This prevents one party from gambling with the other's future. Furthermore, you should request a joinder. A joinder is a legal process that makes the 401k plan itself a party to the divorce. Once the plan is joined, the administrator is legally put on notice that a split is coming, which can prevent the participant spouse from taking out new loans or making secret withdrawals before the QDRO is processed. This brings us back to the macro-level view of U.S. wealth distribution. The reason the top 10% continue to grow their lead is that they treat these administrative hurdles as a professional chess match. They don't just hope the plan administrator gets it right. They join the plan to the lawsuit, they hire the actuary for the pension appraisal, and they negotiate the QDRO review fees up front. For the middle class, these costs are often an afterthought, which leads to a death by 1,000 cuts scenario where legal fees, administrative fees, tax penalties, and poor investment timing collectively strip 20 to 30% of the total value away during the transfer. Consider the reality of the 2026 job market. Americans are switching jobs more frequently than ever, leaving a trail of zombie 401ks at previous employers. In a divorce, if you don't list every single one of those accounts, they aren't just forgotten, they become a legal liability. If Marcus has an old 401k from a job he held 10 years ago that he never rolled over, Chloe's attorney can argue that he was hiding assets. Even if it was an honest mistake, the legal cost to defend against a fraudulent concealment claim can far exceed the value of the old account itself. This is why a comprehensive asset trace is the first step in any wealth-aware divorce. You must use the Department of Labor's abandoned plan database and your own Social Security earnings record to ensure every penny is accounted for. Step by step, the process for a secure transfer in 2026 looks like this. Step 1, the joinder of the plan. Step 2, the pension appraisal for present value. Step 3, the standing order to freeze investment allocations. Step 4, the drafting of the QDRO by a specialist, not a general practice lawyer. Step 5, a pre-approval letter from the plan administrator before the judge ever signs the order. If you skip Step 5 and the judge signs an order that the plan rejects, you have to pay your lawyer all over again to start the process from scratch. This level of detail is exhausting, and that is precisely why the wealth gap persists. The system is designed to reward those who can afford to pay for precision. But by understanding these mechanics, you can level the playing field. You can stop being a victim of the process and start being a manager of your own distribution. But what happens when the 401k is actually an ESOP, or an employee stock ownership plan? What if the company isn't publicly traded, and the value is whatever the board of directors says it is? And how do you handle the alimony conversion trick, where a 401k distribution is used to satisfy future support obligations in a way that creates a massive tax loophole for one spouse while leaves the other vulnerable? In the next part, we are going to dive into the world of ESOPs and private company valuations. We will look at how to handle non-qualified deferred compensation plans, the secret accounts of the executive class that often stay hidden during a standard divorce. We are going to show you how to peel back the layers of a corporate benefits package to find the wealth that isn't listed on a standard 401k statement. The deeper we go, the more you will realize that what you see on your screen is only a fraction of what is actually at stake. The deeper we go, the more you will realize that what you see on your screen is only a fraction of what is actually at stake. For many middle to upper management professionals in 2026, the 401k is merely the visible tip of a much larger financial iceberg. If you are only looking at the 401k statement, you are likely missing the non-qualified deferred compensation plans, often referred to as NQDC or Top Hat plans. These are the specialized vehicles used by the executive class to bypass the contribution limits of a standard 401k. To understand the risk and the opportunity here, let us look at a case study involving a character named James, a senior vice president at a tech firm in Seattle. James has a 401k worth $400,000. But because he is a high earner, his company also allows him to defer a massive portion of his salary and bonuses into an NQDC plan. This account currently sits at $1.2 million. Here is the trap. Unlike a 401k, an NQDC plan is not governed by ERISA. It is technically an unsecured promise from the employer to pay James in the future. In a divorce, James's spouse, Linda, might see that $1.2 million balance and demand half. But if Linda's attorney treats this like a 401k, they are making a catastrophic error. You cannot use a QDRO for a non-qualified plan. Instead, you need a specific type of domestic relations order that accounts for the fact that this money is subject to the company's creditors. If the tech firm goes bankrupt in 2027, that $1.2 million could vanish completely. Historically, case studies of executive divorces during corporate collapses show that the spouse who took the safe, 401k, and the house ended up far wealthier than the spouse who took the massive unsecured deferred compensation. This brings us to the Employee Stock Ownership Plan, or ESOP. Imagine a character named Maria who works for a successful, privately held construction firm in the Midwest. The firm is 100% employee-owned through an ESOP. Maria's statement shows she has $500,000 in company stock. In a 2026 divorce, how do you split an asset that has no public ticker symbol and cannot be sold on the open market? Private company valuation is one of the most contentious areas of U.S. wealth distribution. The company might perform a valuation once a year for IRS purposes, but that number is often conservative. Maria's spouse might hire a forensic accountant to argue the firm is actually worth double the internal valuation based on current market multiples. The step-by-step reality of an ESOP split is grueling. First, you must determine if the plan even allows for an alternate payee to hold shares. Most private ESOPs do not. This means Maria must buy out her spouse's interest. But where does the cash come from? If Maria doesn't have $250,000 in a savings account, she might be forced to take a highly taxed distribution from the ESOP itself, or worse, offset the value by giving up her entire share of the family home. This is a primary way that paper wealth, in the American middle class, is liquidated and destroyed during a divorce. The spouse who keeps the private stock might eventually see it grow to millions, while the spouse who was bought out sees their cash eaten by the 2026 inflation rates and housing costs. Now, let us examine the alimony conversion trick. In the past, alimony was tax-deductible for the payer and taxable for the recipient. The laws changed, but in 2026, savvy planners are using 401k distributions as a surrogate for alimony to regain some of that tax efficiency. Imagine James owes Linda $5,000 a month in support. Instead of paying her from his after-tax salary, he agrees to give her a larger share of the 401k via QDRO. Because Linda can potentially access QDRO funds without the 10% penalty, though still paying income tax, she gets the cash she needs, and James effectively pays his alimony with pre-tax dollars. However, the risk for Linda is immense. By taking the 401k money now to fund her current lifestyle, she is depleting the very asset that was supposed to provide for her at age 70. She is trading future compound interest for current liquidity. Historical trends show that spouses who use retirement assets to fund post-divorce living expenses often find themselves in the bottom 40% of the U.S. wealth distribution within a decade. They have effectively burned their seed corn. We must also talk about the shadow liabilities of the executive benefits package. Many 401ks for high earners are linked to restricted stock units, RSUs, or performance stock units, PSUs. In 2026, these units often have complex vesting triggers based on the company's stock price or EBITDA targets. If you are the non-employee spouse, you need to ensure the divorce decree includes a constructive trust clause. This means that even if the shares haven't vested yet, the employee spouse is legally obligated to hold your portion in trust for you until the trigger is met. Without this, the employee could quit the day after the divorce, forfeit the unvested shares, and then take a new job with a massive signing bonus, effectively resetting their wealth while leaving the ex-spouse with nothing from the previous years of marital labor. This complexity is why the wealth gap in the U.S. is not just a result of income, but a result of contractual literacy. The top 1% of earners have their wealth protected by thousands of pages of corporate and tax law. The middle class has a one-page 401k summary. When these two worlds collide in a courtroom, The person with the most complex contract usually wins by default because the other party cannot afford the forensic expertise to deconstruct it. Step by step, if you suspect there are hidden executive assets, you must perform a proxy statement audit. For public companies, the SEC requires the disclosure of executive compensation in a document called a Def 14A. This will list the NQDC plans, the RSU schedules, and the change in control agreements. Even if your spouse isn't the CEO, their compensation structure likely mirrors the one described in the proxy. You must look for excess benefit plans, which are designed to keep the executive whole if the 401k limits are hit. These are the gold mines of a divorce settlement that are almost never found on a standard 401k portal. This brings us to a fundamental shift in the 2026 American economy. Wealth is no longer just money in the bank. Wealth is a series of future claims on corporate cash flows. If you don't secure your claim during the divorce, you are voluntarily opting out of the U.S. wealth distribution for the next generation. We are seeing a rise in gray divorce. People over 50 splitting up, where the 401k and the NQDC plan are the only things standing between a comfortable retirement and relying on a strained social security system. But what happens when the 401k is held in a self-directed account that contains non-traditional assets like real estate or private equity? How do you value a half-finished apartment complex held inside a 401k? And what is the successor beneficiary trap, where an ex-spouse accidentally inherits the entire account 10 years after the divorce because of a single missing form? In the next part, we are going to look at the self-directed 401k SDA and the nightmares of illiquid asset splits. We will also expose the beneficiary designation ghost, the number one reason 401k wealth ends up in the wrong hands regardless of what your will or divorce decree says. We are going to show you the specific paperwork that plan administrators prioritize over court orders and how to make sure you are protected against the ultimate administrative failure. The deeper we go, the more it becomes clear. In the 2026 economy, the paperwork is the payout. In the 2026 economy, the paperwork is the payout, and nowhere is this more evident than in the catastrophic phenomenon known as the beneficiary designation ghost. To understand how this spectral administrative error haunts the U.S. wealth distribution, we have to look at the hierarchy of legal authority. Most Americans believe their last will and testament is the final word on who inherits their assets. In reality, when it comes to a 401k, a will is often legally subordinate to the beneficiary designation form held by the plan administrator. Consider the case study of a character named Thomas, a warehouse manager in Pennsylvania. Thomas divorced his first spouse, Linda, in 2018. The divorce decree was ironclad. It stated that Linda waived all rights to Thomas's 401k. Thomas eventually remarried a woman named Susan in 2022. When Thomas passed away unexpectedly in early 2026, he left behind a 401k worth $600,000. Susan assumed the money was hers. However, Thomas had never updated the beneficiary form on his employer's HR portal. It still listed Linda. Despite the 2018 divorce decree, despite the second marriage, and despite the intentions written in his will, the Supreme Court of the United States has historically upheld that under ERISA law, the plan administrator must pay the person named on the form. This is the plan documents rule. In this case study, Linda receives the full $600,000, and Susan is left with zero. This isn't an anomaly. It is a recurring systemic failure that drains billions of dollars away from intended heirs every year, reshuffling wealth in ways that are often arbitrary and devastating. This is why the first step in any wealth-aware life transition is not calling a lawyer, but logging into your retirement portal to audit your designations. Now, let us transition into the complex world of the self-directed 401k, or SDA. In 2026, a growing segment of the American workforce, particularly those in the upper middle class, has moved away from standard mutual funds. They are using SDAs to invest in non-traditional assets like residential real estate, private equity, or even physical gold. Imagine a character named Karen, a freelance consultant who has a solo 401k. Inside that 401k, she doesn't have stocks. She owns a 50% stake in a small apartment complex in Arizona. When Karen and her spouse, Stephen, decide to divorce in 2026, the 401k split becomes a logistical nightmare. You cannot simply cut an apartment complex in half with a QDRO. To divide the asset, they must first determine its fair market value, which requires a specialized appraisal that can cost thousands of dollars. If Stephen is awarded 50% of the 401k's value, Karen is faced with a liquidity crisis. She cannot sell the apartment complex overnight, and the 401k plan rules may prohibit her from taking out a loan large enough to pay him out. This leads to the illiquid asset split trap. Potential outcomes in these scenarios often involve forced liquidations. If Karen is forced to sell the property in a down market to satisfy the divorce settlement, she isn't just losing half the value. She is losing the future rental income and the appreciation potential. This is a primary driver of wealth erosion for small business owners and independent contractors. While a 1%er might have the liquidity to keep the asset intact and pay the spouse from other funds, the middle-class professional is often forced to dismantle their best-performing investments just to satisfy a court order. Furthermore, we must address the successor beneficiary trap. In 2026, many 401k plans have introduced a tiered beneficiary system. If the primary beneficiary is an ex-spouse and they are still listed, they get the money. But if the primary is deceased and the successor is a child from a previous marriage, the current spouse can still be legally disinherited. Under the Retirement Equity Act of 1984, a current spouse is legally entitled to be the beneficiary of a 401k, unless they sign a specific, notarized waiver. However, if the account was established before the marriage and the designation was never changed, the legal battles that ensue can consume 20 to 30% of the account's value in attorney fees alone. This brings us to the administrative friction of the 2026 401k landscape. Plan administrators are increasingly automated. They are not looking at your divorce decree for intent. They are looking for specific codified language that matches their internal systems. If your QDRO uses the term total balance, but the plan differentiates between vested balance and account balance, the QDRO will be rejected. While your lawyer bills you $400 an hour to fix the typo, the market continues to move, and your wealth continues to leak. To navigate this, you must understand the difference between a separate interest QDRO and a shared payment QDRO. A separate interest order carves out a piece of the account and gives the ex-spouse their own separate account that they can control. This is almost always the preferred path for wealth preservation, because it allows both parties to go their separate ways and make their own investment choices. A shared payment order, however, only pays the ex-spouse when the participant spouse starts taking distributions. If the participant spouse decides to delay retirement until age 75, the ex-spouse is stuck waiting for their money, with no control over how it is invested in the meantime. In the context of U.S. wealth distribution, these technicalities act as a filter. Those who understand the administrative mechanics are able to maintain the compounding trajectory of their assets. Those who rely on common sense or general practice attorneys often see their retirement security bifurcated or delayed by decades. We are moving into an era where financial literacy must be replaced by administrative literacy. It is no longer enough to know how to save. You must know how to defend your savings from the procedural traps of the federal government and corporate HR departments. Step by step, the audit for an SDA or an account with beneficiary issues looks like this. Step 1. Obtain the plan document. Not just the summary, but the full legal contract. Step 2. Verify the spousal waiver status for any account held during a marriage. Step 3. For illiquid assets, secure a letter of instruction from the plan custodian regarding their specific requirements for a QDRO-based asset transfer. Step 4. Update your online beneficiary profile. And crucially, download a timestamped PDF confirmation. In 2026, a screenshot is often your only defense against a database error that could cost your family their entire inheritance. This administrative gauntlet is the reality of the American middle class. We have traded the simplicity of the pension for the freedom of the 401k, but that freedom comes with a massive burden of legal and procedural risk. The 401k is a weapon of wealth creation, but in a divorce, it is a weapon that is often pointed at both participants. But what if the 401k is only one part of a multi-generational wealth strategy? What happens when you have a 401k that you intend to pass down to your children, but the 10-year rule of the Secure Act changes your tax calculations? And how do you handle the tax-efficient swap, where you trade 401k assets for a higher share of the cost basis in a primary residence? In the next part, we are going to dive into the basis step-up and how it interacts with 401k settlements. We will look at the 10-year distribution clock and why your children might end up with a massive tax bill because of how your divorce was structured 20 years prior. Most importantly, we will reveal the asset location strategy, why it might be better to give your spouse the 401k while you keep the taxable brokerage account, and the secret math that makes this move a potential win for both parties. The deeper we go, the more you will see that the best divorce settlement isn't the one that is equal, but the one that is optimized. The deeper we go, the more you will see that the best divorce settlement isn't the one that is equal, but the one that is optimized. In 2026, the concept of a 50-50 split is often a financial trap because it assumes all dollars are created equal. They are not. To understand the sophisticated math behind the tax-efficient swap, let us look at a case study involving a character named Catherine, a medical researcher in North Carolina. Catherine has a 401k worth $800,000, and she and her spouse Daniel own a home with $800,000 in equity. A standard mediator would suggest Catherine keeps the 401k and Daniel keeps the house. On paper, they both walk away with $800,000. This is a massive mistake. Daniel is receiving $800,000 in home equity, which, under the current U.S. tax code, can be sold with a significant capital gains exclusion, up to $250,000 for a single filer. The rest of his gain is taxed at favorable long-term capital gains rates. Catherine, however, is keeping $800,000 in a traditional 401k. Every single time she withdraws money in retirement, she will pay ordinary income tax. If her effective tax rate in the future is 25%, her $800,000 is actually only worth $600,000 in spendable after-tax utility. Daniel effectively walked away with $200,000 more wealth than Catherine simply because of the asset type. This is the essence of the asset location strategy. You must value assets based on their net liquidity, not their gross balance. In a wealth-aware divorce in 2026, Catherine's attorney would argue for a tax adjustment discount. She might demand a larger share of the 401k, perhaps $900,000, to offset the future tax burden, or she might swap the 401k for a taxable brokerage account. This leads us to the hidden benefit of the taxable brokerage account, the basis step-up. When you hold stocks in a regular brokerage account, you only pay tax on the growth or the capital gains. If you inherit these stocks or hold them until death, your heirs often receive a step-up in basis to the current market value, effectively wiping out the tax bill on decades of growth. 401ks do not get a step-up in basis. By choosing the 401k over the brokerage account in a divorce, you are opting into a permanent tax liability that your spouse is avoiding. This is a primary driver of the wealth gap between divorced individuals. One is building a tax-free or tax-advantaged legacy, while the other is perpetually paying the government for the right to spend their own money. Now, let us look at the 10-year distribution clock, a critical component of the Secure Act and its 2026 iterations. For middle-class families intending to pass wealth to the next generation, how you split your 401k today dictates the tax burden your children will face decades from now. Most non-spouse beneficiaries, such as children, are now required to fully distribute an inherited 401k within 10 years of the original owner's death. If Catherine leaves her $800,000 401k to her two children, they may be forced to take $80,000 each per year in extra income. If they are in their peak earning years, this could push them into the 37% tax bracket. However, if the divorce settlement had been structured so that Catherine kept more of the primary residence or a Roth converted account, she could pass down assets that have no such distribution requirements or tax liabilities. Historically, we see that the top 10% of households use divorce as an opportunity to clean up their balance sheets. They move highly taxed assets to the spouse who expects to be in a lower tax bracket in the future, and keep the high-growth, tax-efficient assets for themselves. They are not just splitting the present, they are optimizing the future. This brings us to the math of the Roth conversion during a divorce. In 2026, the tax brackets are in a state of flux. If a couple is splitting an account, it may be the most opportune time to perform a Roth conversion. Imagine Daniel takes $400,000 of the 401k via QDRO. He can choose to roll that directly into a Roth IRA. While he must pay income tax on that $400,000 now, he can often negotiate to have the tax bill paid out of the joint marital funds before the final split. This allows Daniel to walk away with a $400,000 account that will grow tax-free for the rest of his life and has no required minimum distributions. For a 40-year-old, the potential outcome of this move over 30 years is a difference of millions of dollars in net worth compared to staying in a traditional 401k. But how do you convince a spouse to agree to this? This is where the art of the trade-off comes in. You might offer your spouse a higher percentage of the liquid savings in exchange for the right to use marital funds to pay for your Roth conversion. You are trading current cash for future tax-free growth. For the spouse who needs liquidity now to restart their life, this is an attractive deal. For the spouse focused on long-term wealth distribution, it is a masterstroke. Step by step, an optimized settlement audit in 2026 involves 3 pillars. Pillar 1 is the tax comparison. You must list every asset and its projected tax-impacted value. Pillar 2 is the step-up analysis. Identify which assets will benefit from a basis step-up and prioritize keeping them. Pillar 3 is the multi-generational stress test. Run a simulation of how these assets will look when they eventually pass to your heirs under the current 10-year rule. If the settlement doesn't pass these 3 pillars, it isn't an optimized agreement. It is just a temporary peace treaty. The systemic reality of the U.S. wealth distribution is that the law is written for the average, but the wealth is built in the exceptions. The 401k is a standardized average tool. To make it work for you during a divorce, you have to treat it like a specialized instrument. We are seeing a trend where individuals who ignore these tax-efficient swaps end up with a high nominal net worth but low financial freedom. They are asset-rich but cash-poor, burdened by the silent lien the IRS holds on their retirement accounts. As we look at the broader landscape of 2026, we see that the middle class is increasingly squeezed by these administrative and tax complexities. The wealth gap is widening not just because of what people earn, but because of how much they lose during transitions. Divorce is the single largest wealth event most Americans will ever experience outside of buying a home. If you approach it with the mindset of 50-50, you have already lost. You must approach it with the mindset of maximize and offset. This leads us to the final and perhaps most controversial part of this masterclass. Beyond the math, beyond the taxes, and beyond the QDROs, there is a human element that the algorithms cannot capture. It is the concept of financial velocity. It is the ability to bounce back and rebuild after the paperwork is signed. Some assets provide more velocity than others. Some accounts offer the ability to leverage, to borrow, and to reinvest in ways that a locked-up 401k cannot. In our final part, we are going to synthesize everything we have learned. We will look at the post-divorce rebound, how to use your newly structured assets to leapfrog back into the top percentiles of wealth. We will reveal the ultimate 401k defense strategy for those who are still married but want to bulletproof their future. And finally, we will look at the 2027 and 2028 legislative forecasts. What is coming next that could make everything we discussed today even more critical? The final part of the puzzle is about more than just surviving the split. It is about winning the decades that follow. To win the decades that follow a 401k split, you must master the concept of financial velocity. In the wake of a 2026 divorce, most individuals feel as though they have been reset to zero or worse negative territory. But wealth in the United States is not a static pool. It is a vector of movement. The speed at which you can redeploy your remaining assets determines whether you remain in the shrinking middle class or ascend back into the ranks of the top 10%. To illustrate this, let us look at the final case study of this masterclass. A character named Anthony, a mid-career logistics director in Atlanta. Anthony walked away from his divorce with $300,000, half of his original 401k. He felt defeated, watching his compounding engine get sliced in half. However, Anthony understood the difference between debt capital and live capital. Debt capital is money sitting in a plan with high administrative fees, limited investment options, and a looming tax lien. Live capital is money that is strategically located to capture the next wave of economic growth. Anthony did not just leave his $300,000 in his old employer's plan. Within 48 hours of the QDRO being finalized, he executed a direct rollover into a self-directed IRA that allowed him to participate in specialized sectors that his employer's plan had blocked. By increasing his financial velocity, Anthony was able to look at the 2026 and 2027 legislative forecasts with a sense of opportunity rather than fear. One major historical trend we are seeing in 2026 is the potential sunsetting of current tax brackets. If tax rates are projected to rise in 2027 or 2028, the value of a traditional 401k decreases while the value of a Roth-style account increases. Anthony used a portion of his settlement to perform a series of strategic Roth conversions during a year when his income was temporarily lower due to the transition. He paid the tax at the 2026 rate to protect the growth for the next 30 years. This is how you win the decade. You anticipate the macro shifts in the U.S. tax code and move your assets before the door closes. Furthermore, we must address the bulletproof future strategy for those who are currently married, but watching the shifting landscape of U.S. wealth distribution. In 2026, the rise of the postnuptial agreement has become a standard financial planning tool, not a sign of a failing marriage. A postnuptial agreement allows a couple to define their retirement assets as separate property, while they are still in a state of cooperation. For example, a couple might agree that while their home is a joint asset, their respective 401ks will remain separate property regardless of future contributions. This simple document creates a legal firewall that prevents the QDRO nightmare from ever occurring. It keeps the compounding process intact for both parties, ensuring that even if the family unit dissolves, the financial engines do not. Step by step, the post-divorce rebound requires a 3-month audit. Month 1. Asset consolidation. You must track down every small 401k from previous employers and roll them into a single high-control vehicle. Month 2. Beneficiary scrub. You must verify every single form to ensure the beneficiary designation ghost does not haunt your new life. Month 3. Risk realignment. Your risk tolerance as a single individual is fundamentally different than it was as part of a couple. You may need to be more aggressive to catch up, or more conservative to protect your remaining principal. As we look toward the end of the 2020s, the U.S. wealth distribution is becoming increasingly binary. You are either a passenger in a system designed to extract fees and taxes, or you are a pilot of your own distribution. The 401k was once marketed as a set-it-and-forget-it solution. In 2026, we know that to be a myth. It is a highly sensitive legal and financial instrument that requires constant calibration. The individuals who are thriving in this economy are the ones who treat their 401k as a dynamic business asset, not a passive savings account. We also have to consider the role of the 2026 Secure Act 4.0 rumors. Legislative discussions are already pointing toward further restrictions on high-balance IRAs and 401ks. There is a potential outcome where the government may impose mandatory distributions on accounts over a certain threshold, regardless of age. If you are a high earner, your divorce settlement might accidentally put you over these thresholds, triggering new taxes. This is why you must build flexibility into your settlement. You want a mix of pre-tax, Roth, and taxable brokerage assets. Diversification is no longer just about which stocks you own. It is about which tax laws you are subject to. Imagine if every American understood the QDRO before they signed a marriage license. Imagine if the thousands of dollars spent on forensic accountants were instead left to compound in the market. The wealth gap in this country would look very different. But the system is built on complexity because complexity creates revenue for the institutions that manage it. Your job is to simplify your exposure. You do this by being the most informed person in the room. You do this by realizing that the 401k is not just money. It is time. It is the time you spent away from your family, the time you spent at a job you may not have loved, and the time you hope to enjoy in the future. Protecting that time is the most important financial goal you will ever have. In the final analysis, the 401k divorce is a microcosm of the American economic struggle. It is the intersection of our most private lives and the most public laws. Those who survive and thrive are those who can navigate that intersection with precision. They understand that a 50% split is rarely 50% in reality. They know that a QDRO is a weapon if used correctly and a trap if ignored. They recognize that the government is a silent partner in every retirement account, and they plan accordingly. This concludes our deep dive masterclass on 401k divorce and the U.S. wealth distribution. We have moved from the macro-level statistics of inequality to the micro-level mechanics of the tax code. We have looked at the legal traps of the QDRO, the forensic secrets of tracing separate property, and the high-level strategies of the tax-efficient swap. You now have the blueprint that the top 10% use to protect their compounding interest during the most volatile periods of their lives. The journey doesn't end here. The rules of the game are constantly being rewritten in Washington and in the courts. To stay ahead, you must remain vigilant and continue to audit your plan, your designations, and your strategy every single year. Wealth is not a destination you reach. It is a position you defend. By applying the lessons of this masterclass, you are no longer a victim of the system. You are a strategist. You are a protector of your own legacy. And most importantly, you are prepared for whatever the 2026 economy and beyond has in store for you. The next evolution of this conversation involves the rise of the family office model for the middle class. How are everyday families using private trust structures to bypass the 401k system entirely? And what happens when the 401k is no longer the primary vehicle for American retirement? Those are the questions that will define the next decade of wealth in the United States. Stay focused, stay informed, and keep your financial velocity at its peak.